All right, let's get right into it. Today we are tackling the big question that's probably on every Indian investor's mind right now. What on earth is going on with the Nifty 50? After an amazing run, the market's taken a bit of a hit, and that's making folks a little jumpy. So let's dive in and see what the data is really telling us.
So, here's our starting point. As of Friday's close, March 6th, 2026, the Nifty 50 was parked at 24,450. Now, that's a huge number, no doubt, but it's not the number itself. It's the recent direction that's got everyone talking. And there it is. The market is down over 7% from its latest all-time high. And look, when you see your portfolio take a dip like that, it's totally normal to feel that little knot in your stomach. And that feeling leads us right to the central question we're trying to answer today. So what is this? Is it just a temporary storm? Some geopolitical noise that'll blow over in a week or two? Or is this the start of something more serious? A deep freeze for the market? To figure that out, we can't just look at today's headlines. We've got to zoom out. We need to look at history. And that brings us to our first major point. You see, the market has a memory, and by looking at how it's behaved during past crises, we can actually find some really powerful clues about what could happen next. Okay, now what's so fascinating about this slide is the pattern. Just look at the insane scale of these drops. A staggering 65% haircut during the global financial crisis, a 40% crash during COVID. I mean, each one of these events felt like the sky was falling at the time. But here's the kicker. In every single case, the market not only recovered, it roared back to set brand new all-time highs. The key takeaway here is that recovery isn't the exception, it's the rule. Let's just zero in on the craziest, most recent example, the COVID crash. In just 46 trading days, that's less than 2 months, the entire index just collapsed by 40%. It was terrifying, one of the fastest falls ever. But the recovery was just as mind-blowing. In only 10 months, it was all back. And get this, from that bottom of around 7,500, the index has more than tripled since. It's the perfect example of the market's incredible power to rebound. And this quote from Moneyvesta just hits the nail on the head. History shows us that the biggest losses don't come from the market crashes themselves. Nope. They come from the panic selling right at the bottom. It's that fear of things getting worse that tricks investors into bailing out right before the incredible recovery that almost always follows. Okay, so history says the market always bounces back. But what if I told you that something fundamental has shifted, that the market's very DNA has changed, making it even stronger today? Let's move on, because you've got to see what this game changer is. The market we are in right now is not the same one that fell in 2008 or even during other crises. A new, incredibly powerful force has woken up from right here inside India, and it's basically acting like a giant shock absorber whenever things get rocky. And here it is, the SIP juggernaut. I mean, just look at the explosive growth in systematic investment plans. We're talking less than 44,000 crore rupees back in 2017 to nearly 2.9 lakh crore in 2025. This isn't just a chart with rising bars. This represents a seismic shift in how regular Indian households are saving and investing their money. And this is the magic number. Every single month, over 25,000 crore rupees of domestic retail money is now reliably flowing into the market, rain or shine, good news or bad news. Think about that. It's a steady, predictable river of cash that just wasn't there in the past. It creates this incredible floor of support under the market. So, this is the massive structural change we're talking about. You see, before 2020, the Indian market was pretty much at the mercy of foreign money. When foreign institutional investors, or FIIs, decided to sell, our market would tank hard. But now the script has completely flipped. The domestic institutional investors, the DIIs, they're fueled by that river of SIP money we just saw, and they've become this powerful counterforce, the market's new shock absorber, buying up what the foreigners are selling and putting a safety net under the entire market. Okay, that's the theory, and it sounds great, right? But does the hard data actually back it up? Let's take a look at the numbers and see this DI shield in action for ourselves. This table from the IJMRT study is, well, it's just incredible. Look at those huge negative numbers in the FII column. That's massive selling, year after year. Back in the day, this would have absolutely crushed the market. But now, look right next door at the DII column. For every lakh crore that FIIs were pulling out, DIIs were pumping even more in. They literally absorbed all that selling pressure, preventing a collapse, and allowed the Nifty to keep climbing. And it's not just me saying it. Here's the conclusion from the experts who did the research. They confirm it. This isn't just a coincidence. This rise of the domestic Indian investor has fundamentally made our market stronger and way more resilient to global drama than it has ever been before. So, with all that history and this huge structural shift in our back pocket, what does it all mean for the market right now, today? Let's turn our attention to the road ahead. Okay, for the very short term, like this coming Monday, the outlook is what you'd call cautiously positive. That 24,300 level is a really critical support zone, a price where a lot of buyers are expected to jump in. And here's a cool insight from the options data. There's been a huge amount of put writing at 24,300. In simple terms, that means a lot of big money traders are betting the market will not fall below that level, which suggests they think the downside from here is pretty limited. We should probably expect some choppy action, but the technicals are pointing towards stabilization. And now, let's zoom out again. What about the long game? This table breaks down a few potential scenarios for the Nifty over the next 2 to 3 years. Our base case, just assuming a normal historical return of about 12% a year, puts the Nifty over 30,000 within 2 years and pushing towards 34,000 in 3. But look, even in the bear case, the more pessimistic view, the index is still projected to climb higher from where we are today. All of this is anchored by real earnings growth and, of course, that unstoppable flow of domestic money we've been talking about. So let's just end with this thought. The data, whether you look at history or the new structure of the market, it's all sending a very clear message. Every single major fall in the Nifty's past has turned out to be a brilliant opportunity, in hindsight. So the real question for you isn't if the market is going to recover and hit a new high. History strongly suggests it will. The much more important question is, what will you do between now and then? How will you be positioned for it when it happens?